Hello, my name is Daniel Medmoni Ziegler, and in today's video, I will be assessing Western Union. I will be talking about the company's past income statement and balance sheet, and I will use those in order to forecast the company's future. Before I begin, I would like to tell you that I was pretty surprised uh, when I was working on the company because Western Union is a pretty well-known company. So I thought the company is solvent, is financially stable, but apparently it's not, and I'm going to talk about it later. The company's background: it established in 1851 in New York. The founder is Mr. Cornell, Ezra Cornell, who is one of the founders of Cornell University, is one of the best universities in the world. The headquarters are in Denver, Colorado. The company started as a telegraph company and only later on evolved into a money transfer company. And we can actually see the company's locations, the company's agents, pretty much everywhere on the street, on the corner. And one of the first companies that invented the credit card was Western Union. Back then, it was called Metal Money. With regarding operations, the company operates in more than 200 countries, has more than 500,000 of agents, deals with more than 100 currencies, and it accounted for more than 300 billion of money transfer in 2019, according to the company's website. Stock value is around $22 and the market cap is slightly more than $9 billion. With regard to the historical income statement and the balance sheet 2017 through 2019, the company is overall not doing well. There are many fluctuations in several accounts. This is the income statement from 2017, 2018, and 2019. We can see that revenues overall decreased from 2018 to 2019, but if we go back to 2017, this was the revenues, and they increased by almost 1.2% in 2018, and then they decreased by almost 5.5% in 2019. Same goes for cost of goods, cost of services, cost of goods sold. It started higher in 2017. It got lower by almost 1.5%, and then it got lower again by almost 7% in 2019, which supposedly is a good figure because we want to keep expenses as low as possible. But then selling, general, and administrative costs increased. So it started higher in 2017, then it went down in 2018 by more than 5%, which is good. But then it went up again by almost 10%. So it's a little bit confusing. Goodwill impairment charge, we can see that in 2019, 2018, this amount is zero, and in 2017, it was around 460 million. Total expenses over this time period, the 3 years, has overall decreased. It started fairly higher in 2017. It went down. This amount is lower compared to 2017, and then it further went down in 2019. So it's again a good measure, but operating income overall got down. So yeah, in 2017 it was lower compared to 2019. It went up in 2018 by a lot, more than 100%, but then it went down by more than 15%, which tells me that this amount in 2018 might have been just, arbitrary, just random, not something that happens every day to the company. And other income expense accounts. So overall interest income increased, which is good. It means that the company receives money for lending its money. Interest expense went up. So the company pays more on borrowings, which is not good, but overall these values are pretty much consistent, pretty much the same. Other income net, again, started lower in 2017, went up in 2018, and then it went down again in 2019. So there is somewhat fluctuations. Total other income expense net, it was negative again, and then it was positive, which is supposedly good. The company had more income and less expenses. And income before income taxes was higher in 2019 compared to 2018 and to 2017. And overall net income was higher in 2019 compared to both 2018 and 2017, in which net income was negative. However, it's super important to mention it. This is the only item that allowed the company to have the highest net income among the 3 years. So if it weren't for this account, for this item, the company's net income in 2018 would have been lower than the company's net income in 2018. And we need to consider it when we are forecasting the future. This is the balance sheet. We can see that the overall assets or cash and equivalents, increased from 2017 through 2019. Settlement assets, however, decreased. The same goes for property and equipment. Overall decreased. Yeah, there was a slight increase in 2018, but then it got down. Goodwill and other intangible assets, overall they went down, which might imply that the company goes through some phase of reduced operations, and we can actually see it once we do the summation, and we see that the overall total assets in 2019 was lower compared to both 2018 and 2017. Obviously, total assets, it goes hand in hand with total liabilities and shareholder equity. So if this item goes down compared to those 2 years, then total liabilities would go down as well. So these two figures, total assets and total liabilities, and obviously total liabilities and stockholders deficit, which I'm going to talk about shortly, suggests that the company is reducing its operations. Maybe it has less assets, so it doesn't need as many liabilities to fund those assets, which it's not a good thing, because usually we want the company to have as many assets as possible, because it means that the company has more money, is more solvent. We can see here under stockholders deficit, it's not even stockholders equity, that the company does not issue preferred stock at all. The company probably repurchased its common stock from 4.6 to 4.4 to 4.2, and the capital surplus has increased. So it started lower, got higher, and then it got higher again, implying that the company is probably repurchasing its stocks and it does not issue stocks at all. And then, and it's very concerning, the overall total stockholders' equity is actually a deficit. So the company has a negative retained earnings, as you can see here in red, negative, obviously, comprehensive loss, So the result is that the total stockholders deficit is negative, which is not good. So the assumption for the future is that the company will not do well with regard to its income statement and its balance sheet. The interpretations. So, as I just said, the company is not supposed to do well in both income statement and the balance sheet and obviously the cash flow, but I'm not going to talk about the cash flow in this video. And this is data retrieved from the company's financial statement annual report in 2019. They even confirmed the assumption. They say they evaluate the performance. They might sell businesses or product lines. They face credit, liquidity, and fraud risks. They have issues, and this is why we can see that both the income statement and the balance sheet, they have many fluctuations, and this is what made me assume that the future will be pretty much the same, meaning that we're gonna see lower amounts in accounts in both the income statement and the balance sheet. Now this is the graph of the sales in the past 8 years. We can see overall a decrease in sales, and here again percentage change. So 1 year it's higher, then the next year is lower, then the next year is higher, then the next year is lower, and so on and so forth. We can see that the company is not able to keep its sales stable and consistent. So there is an overall decrease in sales, there is fluctuation in sales figures, there are so many inconsistencies, and the future might not be promising. For forecasting the future, I use the linear model, the baseline. It's basically tells the best story. We can see that all models, they assume that future sales in 2020 would be higher by at least 6%. And then in the following 2 years, 21, 22, sales would be lower by less than 1%, but it's still a negative figure. This is the baseline model, the future forecast of the income statement. We can see that in 2020, revenues would be higher, as I just said, but then in the following 2 years, 21, 22, revenues would be lower by more than 0.5%, which is still a negative figure, which is not good. Cost of services, it started higher and then it just went lower and lower, which is supposedly good because the company has less expenses in this item. And then selling and administrative expenses, they started higher, they went lower, and then they went lower again. Total expenses, the same thing, started higher, then they went lower, and then they went lower again. But operating income in 2020 was lower compared to 21, 22, and then it just went up. So these two lines, I would say, those accounts, the revenues and expenses, they tell a good story. The company is assumed to have somewhat better operating income, but it's not as extremely high as to conclude that the company would be doing well in the future. And under other income expenses, the company is going to earn less from its interest expense. From its interest income, I apologize. Interest expense, I assumed it would be constant because the last item in 2019 was negative 152. And since interest expense is something that we cannot know unless we have the data, I just assumed that it would carry over. Other income net overall goes down. Total other income or expense net is again carried over. Income before income taxes was lower, then higher, and then net income or loss is overall higher in 2021, 2022 by overall almost 3%. In my opinion, is not the best. Yeah, obviously those figures are positive. They are higher compared to 2020, compared to 2019. But as we saw here, there are just too much fluctuations. So it just might be, you know, one phase, and then in the future, those figures would go down again. This is the balance sheet. And what I did was basically to do the balance sheet as of as a pro forma. So I divided everything by total assets. We can see the total liabilities are more than total assets, which is not good. And this is why we're going to have a total stockholder deficit, because we have to have total assets equal to total liabilities plus shareholder equity. So in this case, shareholders' equity is going to be negative. So we are not going to have any equity. This is the percentage of sales. So what I did was basically to divide each item by sales of 2017, 2018, 2019. It just gives a better picture of what those items are compared to sales. And it allows me to do the assumption for the future. So we can see that, for instance, cash and equivalents, there is an overall increase in the items. So I used the percentage change and I said it's gonna go up. Probably 30% is a good item, is a good percentage to use, good assumption. And so on. It just applies to all of the other items. Settlement assets overall goes down, so I took the percentage change. Property and equipment, we can see some in 2017 it's lower, in 2018 is higher, and then in 2018 it is lower, all of them compared to each other, so I took the average. Goodwill and intangible assets, those are subjective items. I don't know whether the company will buy more, maybe they will sell more, and so goes for the intangible assets. So I just assume those items would carry over. And we can see that that their corresponding percentage of sales are pretty much similar. So it's reasonable to assume that those items would carry over. Total assets, obviously, it's a summation. Under liabilities, we see that payables and accrued liabilities, it started higher, then it went down, and then it got up again. So I took the average. Settlement obligations started lower, then it went down again. I'm sorry, started higher, then it went down again, then it went down again. So I just took the percentage change. Income taxes payable, I just carried over. Again, I don't know how much they had, how much they will have. So I just assume it's just gonna carry over. Deferred tax liabilities, I took the percentage change. Borrowings, we can see that overall there is slightly some fluctuation. It started lower, then it went up, then it went down again. So I took the average. Other liabilities started higher, went down, and then it just went up, kind of like boost up. So I just took the average. Total liabilities, again, is a summation. For the stockholders' equity, which here is a deficit, obviously, I assume preferred stock, we're not going to have any of them in the future. I left common stock and capital surplus as they are, meaning that I carry them over, because I'm going to modify the balance sheet if I need to, and I'm going to talk about it shortly. Accumulated deficit is just going to go down and down and down, but overall is just slightly lower, slightly lower, slightly lower. So I took the percentage change. Accumulated other comprehensive loss, it started higher, then it stayed the same, then it got lower, so I took the percentage change. Total equity deficit and total liabilities and stockholders deficit is a summation, so I just left it as is. And this is the baseline balance sheet for 2020, 21, 22. Please forgive me for the quality. I did have to do some modifications, some adjustments. So cash and cash equivalents, I had to increase it by 35%. Settlement assets, I had to use the figures in 2019. Property and equipment, I had to increase it by 6%. Other assets, I had to increase it by 13%. And I had to create a short-term investment account just to invest some money. And why I did it was because when I forecasted the future, total liabilities and stockholders deficit was larger, was greater than total assets by those figures, 645, 1590 and 2434. So the company had to increase its assets in order to have the balance sheet balance, because we have to have total assets equal total liabilities plus shareholders' equity, which again, in this case, it's a deficit. So I had to just modify those items in order to have the balance sheet basically correct. Now, the conclusion, the company is not doing relatively well considering the financial statements, the notes, and their opinions and concerns regarding the future. It is reasonable to conclude that Western Union's future is not bright. The company said that they are going through some phase of evaluations, that they have issues, frauds, risks, and so on and so forth. The company has been facing multiple fluctuations in various accounts. It implies instability. Sometimes sales are higher, sometimes they are lower, sometimes assets are higher, sometimes assets are lower. In 2019, there were less assets compared to 2018 and 2017. It just means that the company is not stable, and obviously they sold some of their assets, as we saw under income statement and also under the balance sheet. So it's reasonable to assume, it's reasonable to conclude that the future is not bright. Also, the company has sold, like I said, some of its assets. They repurchased some of its stock. The stock doesn't grow and dividends are relatively small. So as far as I'm concerned, the company will not do well in the future, even though some items on the forecasted income statement and balance sheet are positive, are better compared to prior years. I'm not as positive as to assume that the company would do better in the future, because there are some other factors to consider, some such as COVID-19, inflation rate, supply and demand. Those I have not included in this forecast. And this is all I have for today. I believe Western Union is still an important company, but today's money transfer is way easier with mobile applications, and we can also do it using banks and all of those applications I just said. This is all I have for today. I'm Daniel Medmoney Ziegler. I'm thanking you for watching this video, and I appreciate your support. Thank you. Bye-bye.